Michael Burry reveals the true danger from this doom banking liquidity crisis, why more failures are coming like WorldCom and Enron. The Fed, the White House, and the Treasury and the FDIC are panicking over the biggest bank run and called Biden to assure you on TV that our banking system is safe, right after two banks collapsed unexpectedly, Silicon Valley Bank and Signature Bank. I will let you be the judge over if our banking system is safe or not. Why are those depositors panicking and grabbing their money and running? What is the true danger that Michael Burry refers to? Why the policy response is going to be completely ineffective? Why do you think Warren Buffett sold out of his major position of U.S. Bancorp and his regional bank, Bank of New York Mellon Corp? Last quarter, before any of this had happened, what's the underlying risk of this doom banking crisis? Why more failures are coming like WorldCom and Enron? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? Michael Burry just tweeted 2000, 2008, 2023. It is always the same. People full of hubris, meaning they are being arrogant with exaggerated pride when they're making investing decisions. They are being greedy and take stupid risks and failing. Then the money is being printed by the Fed to extend FDIC limit to unlimited. However, the shareholders and bondholders of these banks will not be bailed out. Their money was lost forever. So this was not a bailout. Banking crisis could put Fed officials in an awkward position on next steps in inflation fight, as CPI came in 6, but core was higher than expected. There is a saying that the Fed Reserve raises interest rates until something breaks. A big surprise over the past year had been that nothing broke. No more. A sharp sell-off in regional bank stocks Monday following the collapse of Silicon Valley Bank. And Signature Bank risks pushing the Fed uncomfortably close to the one place it wanted to avoid over the past year, resolving a financial stability trauma at the same time it fights high inflation. The situation could force Fed Chair Jerome Powell and his colleagues into choosing what problem demands the central bank's top focus. We've always said the one thing that could derail the Fed's tightening would be a financial crisis. It's not clear whether a crisis has been averted yet, said Diane Zhang, chief economist at KPMG. Last week, investors were wondering whether the Fed would raise interest rates at its next meeting by a 1/4 percentage point, as officials did last month, or by a 1/2 point, as they did in December. The turmoil in the U.S. banking industry unleashed a rally in government bonds Monday, with yields on some shorter-term treasuries collapsing 1/2 percentage point in hours. The plunge punctuated how investors have pivoted from worrying about inflation and interest rate increases to focusing on how problems with banks could damage the economy. Until last week, the economy and financial system had shown few obvious side effects from the Fed's aggressive campaign to raise rates over the past year, outside of a sharp slowdown in housing. Then the sudden collapse of Silicon Valley Bank forced a broader rethink among investors about the prospects of regional banks. That in turn could lead to a significant pullback in lending from firms that face pressure to raise deposit rates as the Fed has cranked interest rates higher to fight inflation. Fed officials have at times over the past year acknowledged the risk of being forced to simultaneously fight two problems: financial stability, fallout, and inflation. Several have said they would use emergency lending tools along the lines of the bank funding facility the Fed unveiled Sunday to fight the former, so they could continue to raise interest rates or hold rates at higher levels to fight the latter. The Fed and Treasury unveiled aggressive measures Sunday night, alongside the Federal Deposit Insurance Corp, to backstop uninsured deposits at two failed banks and provide more generous funding to banks to meet demands for withdrawals. Regulators invoke something known as the systemic risk exemption in allowing the FDIC to guarantee uninsured deposits in the two banks, given that it would be a disconnect to raise interest rates next week. Why raise rates if you are worried about a systemic problem to the U.S. economy? Economists at Barclays, which last week said they anticipated a 1/2 point rate rise at the March 21st and 22nd meeting, said Monday they now expected the Fed to hold rates steady in March and leave the door open to a few more increases once the current crisis settles down. Goldman Sachs economist also said Sunday night that they anticipated the Fed would hold rates steady next week, a significant widening in the credit spreads, which will make it more expensive for banks and businesses to borrow, could lead to a sharp pullback in lending that is too much, too fast, and for the Fed. While the Fed wants tighter financial conditions to restrain aggregate demand, they don't want that to occur in a nonlinear fashion that can quickly spiral out of control, perhaps to the detriment of the taxpayer. And while they want credit to become more expensive, they shouldn't want creditworthy borrowers to be shut out at any price. But before the run on Silicon Valley Bank last week, Mr. Powell floated the possibility of a larger increase at the meeting this month, amid signs the economy was gaining unexpected momentum. Nothing about the data suggests to me that we've tightened too much, he said on March 7th before the Senate Banking Committee. This will lead to more fundamental changes in how the banking system operates. If banks face a steady erosion of uninsured transactional deposits from corporate clients, credit creation could pull back, hitting small and mid-sized businesses that have been major employers. In 2008, the Fed was reluctant at times to cut interest rates as the financial crisis intensified because some officials were worried about inflation, which was being pushed up by higher oil prices. But core inflation, which excludes volatile food and energy prices, is considerably higher now than it was then, posing an even stiffer potential test. A separate risk is that the Fed turns less aggressive in its inflation fight and the crisis passes more quickly, worsening the inflation problem. A market melt-up followed Fed rate cuts in 1998. To address the blow-up of hedge fund long-term capital management. It is a policy box for the Fed. Ms. Zhang said the first order of business is to make sure the banking sector is sound and stable. But if those steps ease financial market conditions, you don't know how much you'll derail inflationary pressures. The most beautiful thing we have seen in a long time is the bond yield has crashed huge in a day as TLT jumped above its 200-day moving average. Finally. Sadly, it didn't last. The bond market is still concerned about inflation. But as of now, the Fed funds rate is higher than the 2-year yield, signaling the liquidity crisis crash is coming soon. The cause of the true danger that Michael Burry refers to is the Fed. The Fed is competing with regional banks for these deposits with money market rates at 4.55%. By using reverse repurchase agreement operations, which lead people who want more yield on their money to run on their bank and put the money into the money market. Ultimately, the Fed is the one who caused this problem. The truth is, whoever controls the money controls this world. The Fed, a private corporation, is controlling the White House, U.S. Treasury Department, which is U.S. government who controls the media, thus controlling people's minds. That's why Burry hopes human race to reverse direction. Wake up and seek the truth. And here is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel, and it's about money, the stock market, and stockings. Such an amazing book. Order your copy today. And my client collaboration book, it's already yours, Adversity Equals Success. Such an amazing book with incredible authors. You are such a good boy for watching my video right till the end. Bye.